The right non-QM strategy could save you tens of thousands of dollars, even if you do qualify conventionally. Non-QM loans aren't just a fallback, they're a tool. Used strategically, they can help investors, self-employed buyers, and even high-income earners reduce their payments, minimize taxes, and free up cash flow. If you ignore this strategy, you could be overpaying your lender every month and leaving thousands on the table, money that could be building your investments instead of building your bank's profits. I'm Andrew Russell, owner and founder of RCG Mortgage, top originator across the country via Scotsman Guide, 3P winner of NAMBI Broker of the Year, and I specialize in working with self-employed clients and investors to put them into the right mortgage, and I've saved them hundreds of thousands of dollars in interest and fees by doing so. One of the best agents that I work with, who typically has clients that come into his open house, maybe he's referred them, and then he refers me to his clients to try to work with them on a pre-approval. He actually reached out to me, and instead of having a client for me, alas, he was the client. So he was interested in buying a new construction property in Florida. And as is the case oftentimes, the builder's lender had this amazing sweetheart deal. And that does happen in the industry where, for whatever reason, some of these huge builders have an in-house lender and they basically lose money on the mortgage to keep, the transaction more so in-house. And the deal is not something that any type of mortgage company can compete with. But the deal in of itself, he's obviously an agent, so he's self-employed, and they needed a certain net for him to qualify. So it was around tax season. He was about to actually file his tax returns. And he reached out to me and said, listen, obviously you're not going to work with me on this transaction, but do me a favor. I just want you to look at this as my friend. I want you to see what the deal is that we're getting. Is it outstanding? And is it worth it that I show such a high profit? I don't get to write off the expenses that I typically would, which are allowed per IRS tax code. And with that net, I'll qualify, but I'm paying so much in IRS tax obligations. So I looked, and on his corporate return, he had to show a certain gain, a certain net profit, and he was going to pay something like, $80,000 or $90,000 in federal tax debt, which is crazy. And that doesn't even take into account the state. New York State, he's going to pay another, I think it was about $20,000. So it's almost $100,000 in tax liability just so he can qualify to buy this house, this new construction, which is pretty sweet, not gonna lie, but get a sweetheart deal in doing so. But was the juice worth the squeeze, right? That's the saying. So I was like, you know what? These non-QM mortgage products, if you're a realtor, there's a 1099 non-QM mortgage product, or there's the bank statement program. 1099 will go for his last year, 1099, and his year to date. Bank statement, his last 12 months of his bank statement, seeing the revenue coming in, the cash flow. I said, let me first take a peek. It was something like an $800,000 sale price, and he was putting down 20%. So I said, all right, let's do side by side, at least with our pricing, mortgage broker pricing, which is still outstanding. What is a 20% down conventional 30-year fixed rate mortgage, and what would it be for a 20% down, let's say a bank statement program? So it turned out that the interest rate was 0.5% higher for the bank statement program versus the conventional mortgage program backed by Fannie or Freddie. He had been self-employed for over 5 years, so they allowed a 1-year tax return review, which is why the builder's lender structured it this way. But I took a peek, and it turned out if you actually take a step back and analyze the numbers, which we're definitely going to do in this video, it didn't make any sense whatsoever for him to do the conventional mortgage option. Why? Because if you think about it, $800,000, 20% down, it's a $640,000 loan. So if you pay 1 point or 1%, typically a point gets you a quarter lower in rate. So for instance, on the bank statement program, follow me folks. And check behind me, obviously it's gonna be an illustration. So a $640,000 loan, 1% is $6,400 to get from 7%, which was the 30-year fixed rate on the bank statement program versus 6.5%, which was the conventional option. 1% or a point is $6,400, and that gets you a quarter lower in rate. To get a 0.5% lower in rate, that was $12,800. Now, when people hear they're paying points, they always freak out. They always feel like someone's, pulling the wool over their eyes. Someone's making money that they shouldn't. But if you think about it, $12,800 is what you would pay to get the same rate. But what would he have not had to have done to file those crazy tax returns? Oh, $100,000 in debt. So side by side, you had 6.5% on a 30-year fixed, owing $100,000 IRS tax obligation, both to the feds and to the state, or no IRS tax obligation and an extra $12,000 out of pocket. So it was almost a $90,000 swing. And there is no catch. It's just straight up on a non-QM bank statement program that we go off the bank statements. We don't go off the tax returns. So I was able to show that to him and he showed that to the builder's lender. They don't do non-QM. And then he opted to use our services just because sometimes people are so tunnel vision that the right mortgage options, either number one is what's presented to you, which is always makes sense to shop around, and why you should always work with a broker company because we have the unique opportunity to shop around for you. Or number two, don't just take things at face value. Just make sure that you inquire with whatever the products are today. Specifically, just because most people think and their tunnel vision that a 30-year fixed rate vanilla conventional loan is the T. Sometimes it's not, especially now. This is why I do all these YouTube videos, is because non-QM and the self-employed, specifically the self-employed suite of mortgage products are amazing. Sure, the rate might be a little bit higher, but just think about it logistically. Self-employed clients, why was this created? Because they typically have a harder time qualifying. So he would have had to show a higher net profit, pay a boatload of money to the IRS just to qualify, and then maybe the following years he'll go back to writing off his actual expenses versus the swing of that $80,000 to $90,000. Keep writing off your expenses, keep following IRS tax code, of course, but writing off what you're allowed to. But put yourself into a non-QM mortgage and pay the points if the rate's super important to you for whatever reason. In a decreasing rate environment, it may not be as important to you because people can start refining, hopefully once the rates come down. But it always makes sense to work with a professional, do a forensic of what's the presented scenario, what are all the different options, what are the pros and the cons. Obviously, a con is paying a little bit more in discount points, but it's just a straight up macro pro to me is saving $80,000 or $90,000 out of pocket with no catch. Still 30-year fixed rate mortgage, still vanilla, but an $80,000 swing, that's a win to me. But of course, I hear you saying, Andrew, it's never that easy. I still don't understand. How can you write off all your expenses and then submit your bank statements and it's cool, right? It just is. Again, he or she who has the money and lends it out makes the rules. Specifically, they decided the rule should be 12 months bank statements, look at the money's coming in, as long as there's no volatility month over month or throughout the year, they just use the deposits. They use as little as half of that for income if you're 100% owner of the business, or up to 90% of that if your CPA writes an expense letter saying there's only 10% expenses in the business, but there's flexibility within there. But that's just the guideline. It doesn't matter if you have $80,000 a month in deposits, and at the end of the month, there's $100 left in the account. As long as there's no NSFs or monies that went into the red or the negative, that's a very bad thing. They don't want you overdraw your account, especially many times. But as long as you have the revenue coming in, it's consistent, that's all they base it off of. They take that number, they cut it in half, and if you're 100% on the business, that's what they're going to use. It's just that simple, and it's because, like I said, he or she who lends the money, they do in fact make the rules. Or, hey, Andrew, I'm sure this conventional mortgage for that gentleman would have been so much easier, would have been so much faster, less red tape. No. It's actually not true. I mean, listen, does anybody want to download 12 PDFs of bank statements and send them in? It's annoying. I mean, but is it really annoying? You just log into online banking, you download 12 months, you save it in a folder, and you send it over secure. It's really easy. But outside of that is the paperwork. There's really nothing much left. There's CPA letter, maybe a letter of explanation. Maybe you're renting, so it's proof of your rent payments, but it's a really simple mortgage. It actually is quicker to close on these oftentimes than a conventional loan. So believe it or not, although there's a lot of haterade in the market and everyone always kind of correlates these to subprime mortgages, it's a lot easier to close on them. And of course, the biggest thing is, Andrew, if you take these mortgages, something's going to happen. You're going to end up being foreclosed on. The world always ends. I've seen all the movies. No, that's not the case. Out of 100 non-QM clients I've recently worked with, 99.99999% of them took a 30-year fix. I don't think anyone's ever taken anything but a 30-year fix. I'm sure people have asked about an interest only. They've asked about if the adjustables are lower, but typically right now, the market is driving a 30-year fixed rate mortgage with no prepayment penalty. It's the most safe and pure mortgage that exists. So there really is no concern ultimately for the crash happening again, right? So what happened with the crash? The crash was there was no equity. They were leveraging their whole property. There was such a thing as 125% borrowing power, which is crazy. If your house is worth $1 million, you could borrow $1.25 million against it because they assumed the house was going up in value. That's a little absurd. There was 2, 3, 5-year adjustables. So what happens? 2, 3, 5 years goes fast. I mean, heck, next year my oldest turns 10. I can't even tell you in the last 10 years how fast time has flown. I'll tell you that much. So what happens? You fast forward. Now you have a different job. You don't qualify. You can't refinance. the equity is going down because at that time, at least the market crashed, and now your payment's going up. So you're screwed. So that is not happening. Why? Because these loans, people putting 20, 25, 30% down. So the equity positions are higher. They're 30-year fixed rate mortgages. People aren't taking adjustables, which is super safe. The payment will always stay the same outside of taxes and insurance. And credit profiles. Credit profiles are being checked. 680, 700, 720 is really the minimum score that I've seen people actually have. They allow a little bit lower, but it just seems people applying for these mortgages have been on the sideline waiting to get them. They have great credit profiles, no lates on any trade lines, they're paying rent on time, and of course reserves, money left over in the bank for a rainy day. That's why I feel that the crash that had happened isn't going to happen again, just because although these mortgages sound a little edgy, what we're looking at for income, or at least he or she who's lending the money, the qualifications, the credit, income, and asset side, outside of the income, how they check it, the credit profiles are exponentially better than the crash, and the asset profiles, the money is left over as a non-negotiable from the lending teams. Because people have this, no concern whatsoever. All right, guys, I want to show you in the example, because it sounds too good to be true, right? I want to show you exactly what the original intention of this agent was going to be, what they were going to have to claim an income, and our option. I want to show it to you in writing so you fully understand why the $89,000 in savings, whatever it turned out to be, why it was just so simple. But many times a visual is just a way better illustration versus someone just sitting here speaking. All right, so if we talk through it, let's just say we had an $800,000 one family, putting 20% down. So it's about a $640 loan. And then from there were two options, right? Option number one, let's do a conventional mortgage. Option number two, we're going to do a non-QMer, our favorite. Let's do a bank statement loan, as we said. So just to give you a background of the client again, top producing agent. Let's say 2024. The GCI, gross commissionable income, let's say he made $800,000 for the year. Now, typically, as is, and I'm not saying this one specifically, in any self-employed client, they're going to try to write this down as close to zero as possible. Why? Because you don't want to pay IRS tax obligation. Now, of course, you can't just make up write-offs. It's illegal. You have to have expenses that are allowed, but there are nonetheless expenses that are allowed. So in the case of this agent for the conventional mortgage, this $800,000, instead of writing it down to, I think what he typically did was somewhere between $60,000 and $80,000. He was going to have to write it down, that $800,000 in revenue for the year, to $400,000. And that's what it would take to qualify. There was a lot of stuff going on with his income and his debts and his properties and all this good stuff. So that $400,000, if you show a net profit. Now, if you think of a tax return, right, you have 800. This is the revenue, and then you have some expenses. It gets all added to this section. So say he only did 400. His net profit, it was a 1120S or an S corp. So he had a K1. And it was $400 for the year. That'll flow to his personal returns, and then he will have to pay tax on that. Now, it was in New York, and it was federal. So just roughly, let's say 20% of that is $80,000. This is rough. I'm not going to tell you I'm an IRS tax code guy. I know there's all sorts of things and loopholes, and this isn't my superpower, mortgages. This is just a real rough illustration, but it is pretty accurate. It goes to show you. And then that $400,000, say it was, $20,000 he owed to New York State. It was somewhere around this. So he would have owed $100,000, and this was all to get a rate of 6.5% at the time. For us, if we were offering 6.5%, we actually would have lost money, believe it or not. The builder's lender, they were able to offer a great deal, 6.5%. But is it worth it? It's worth $100,000 to get a rate of 6.5%. Now over here, right, this non-QM bank statement side, so we needed 12 months of his bank statements. So we hopped on, I think he was banking with Chase. Hopped on Chase, downloaded 12 PDFs, sent it over, and for his $800,000, which was right here, for his yearly revenue, it was something like, let's call it $60,000. So it was a little more than that, but like $60,000 a month. So, 1 month was 60, one was 80, one was 40, one was 50, one was 100. You get the gist. So if you added it all together, it equaled about 800. And it made sense. Real estate agents doesn't necessarily mean that every single month has to be the same, but every month, you had deals closing, cash flow coming in. He was crushing it, doing very well. So 800,000 was the yearly deposits. Now, if you divide that by 12, you have, let's just call it $67,000 a month of deposits. So from there, that's the starting point. He was 100% owner of his business. So if you own the business at 100% face value, just initially, organically, you qualify for half of that, which is 33.5, right? Something like that. 33.5 of income per month. That's it. Literally, no catch, CPA letter. This gentleman was 100% owner of that business, which is real estate. 67,000 in deposits. We can give him credit for half that, 33 in income. Now, in this case, it was, similar, that 33-ish thousand in income, but he's going to have to pay $100,000 to get this. Now, the con here was the rate was 7%. To get 6.75 and to get 6.5 would have cost 1% of the loan. And this would have cost 2% of the loan. Now, what was the loan? $640. 1% of $640,000 is $6,400. So you have $6,400 additional cost there, $12,800 additional cost there. So that $12,800 additional cost, that's what it would have taken, or that's what was necessary to get that 6.5 interest rate. So like, Andrew, why the heck would someone pay an additional $12,800? Because what did he not have to pay? This. So anyone, even my kiddos, can do the math here. Would you rather pay $100,000? Because he had no choice here. He's got to pay something. Or would you rather pay $12,800? These are the differences. This would have been non-QM, same interest rate, and this would have been conventional. So literally is a no-brainer. We're saving the guy $87,000 just by being in the right mortgage. So as you can see, picking the right mortgage is very important. This was the BL, right? The builder's lender. They just offered straight up vanilla stuff. Conventional, FHA, that was pretty much it. And even at that, it was a very limited product suite. So just by us being a mortgage broker company offering non-QM, it just made more sense for him to use this option. He had to pick the better of two evils, but $12,800 is an easier pill to swallow than $100,000, obviously. So guys, it's a lot of stuff that goes into these non-QM programs. Make sure you hop in the description, click the link right now before you hop to the next video or whatever you're going to do with your day. Hop in the description, click the link, and make sure you get our free non-QM guide. We spent a lot of time in this guide. It's free. Make sure you grab it because a lot of this stuff, it's easy for me to explain. It's what I do for a living. For you need a keep it simple strategy guide. So hop in our description right now, click the link, and grab that guide. So guys, if this strategy resonated with you, make sure you watch our next video. It's non-QM mortgages, all of your options. This specifically was just someone self-employed, entertaining a conventional loan, but then chose a bank statement loan because it just made more sense, which I clearly showed you in dollars and cents. But make sure you click the link for our next video. We're going to talk about the pros, the cons of all the non-QM loans. So by the end, when you watch the whole video, you'll be an expert just like me.